Hello everyone and welcome to this month's Investor Academy session. I'm Sarah Turner and I'm joined as usual by Angel Academy co-founder Simon Hopkins and our network manager Michelle McQueen. And of course our brilliant speaker, David Bareham, is the Share Schemes Director at haysmacintyre. So as usual, to talk to us and ask questions, please use chat. So before we kick off, just a little bit about us. So Angel Academy exists to close the gender gap in startup investment, both the lack of investment going to female founders and the low number of women angel investing. We've been doing this since 2014. We've backed 44 businesses in that time, many through multiple rounds. So we have more experience than anyone else in female investment in the UK. We've got 3 more deals closing soon, fingers crossed. The businesses we've backed have collectively raised over £100 million from both angels and VCs. They employ many hundreds of people in high quality jobs. They generate millions in revenue, and many have a social purpose at the heart of their mission, whether it be around diversity, better healthcare, lower environmental impact, or anything else. We have a for our investors. Simon and I are both angel investors itself. I think it's very important that we don't encourage others to do what we aren't prepared to do with our own hard-earned money. When we set up Angel Academy, we wanted to create an angel network that worked better for us, one where new investors would be supported, where experienced investors could benefit from other perspectives, where we could do thorough due diligence, but save time by sharing the work. A network that is transparent, respectful, considered, and one that attracts high quality deal through its established track record and reputation. Likewise, we have a strong proposition for entrepreneurs. The network now is experienced and very high caliber. We're fair and transparent, and no surprises as we go along. Our thorough screening process means that most companies that pitch to us will get investment. All but one company did last year. We have a structured process. It's a single point of contact for founders and a clear journey from pitch to investment decision. We really want to make raising from individuals as streamlined as possible. So a little bit about what we look for in the businesses that we're investing in. As angels, we're investing our own money, so we have a lot more flexibility than VCs, but we still need to see return on investment. We don't need billion-dollar valuations and exits, but we do need to see the ambition to get to £100 million or more. So we are looking for founders who prioritise growth. They need to be comfortable giving up some control of their business to shareholders, and they should want to exit within a decent time frame. And last but crucially, they need to be building an innovative or defensible business. We're very lucky to have some great sponsors supporting us at Angel Academy, including haysmacintyre. They advise us and the founders we back. If your company would like to get more involved, please let me know. But for now, back to today's fun. I'm absolutely delighted to introduce David Bareham. He's the Share Schemes Director at haysmacintyre. And as I mentioned before, haysmacintyre have been partners of Angel Academy for 7 years, advising us on a variety of tax and accountancy matters. They're a full service accountancy firm. David has a few slides and I have some questions for him, but we'll have plenty of time for your questions. So please put them in chat as we go along. Over to you, David.
Thank you, Sarah. Hope that's all working now. Oh, I need to start my video. Ah, there we go. There we go. Right. Well,
do you want to share your slides?
Yes, I will just share that one now. Hopefully that's all working now for everybody.
Yeah, looking good.
Excellent. Technology issues out of the way. Well, thank you for the introduction, and yeah, thank you for the opportunity, Sarah, and Simon as well. Thank you. Glad to see so many people on the call to talk about EMI schemes. Clearly, the delightful weather is a bit of a draw, but EMI schemes are as well. So as Sarah explained, I'm going to talk through a bit about EMI. It's an introduction to EMI, so it's aimed towards people that perhaps are considering an EMI or perhaps haven't even heard of one yet. I'm not going to go through too many advanced techie points. We can cover that in a subsequent presentation if there is the demand for it. So I'm going to talk through the basics of what is an EMI, why would you do one, when you should look at implementing one, and lastly, how do you do it? And then I look forward to taking everybody's questions at the end. So without further ado, so we start with, well, what is an EMI scheme to start with? And at a very basic level, it's an enterprise management incentive scheme, and it is an option for an employee to buy shares in their employer or potentially in the parent company of their employer, granted to the employee by reason of their employment. So we value you as an employee. Here are some options over shares in our company. That's broadly speaking the legal structure of it. And those shares can be newly issued or granted by an existing large shareholder or a trust. It's reasonably flexible. But the key about EMI is they're not just standard share options, which have potentially very negative tax consequences, but this is a government-backed scheme that provides significant tax advantages to the employee and also to the company that's implementing it. So it's a tax-efficient way of giving these types of share options to employees. And it's by far the most popular incentive scheme for early to mid-stage growing companies. There are other schemes out there, and in limited circumstances where EMI might not be applicable, we can do other things. But I would say for the vast majority of growing businesses at the early to mid-stage, EMI will likely be the solution. Hence why I'm talking about it now. So that's a broad introduction of what is EMI. We then go into, well, why do companies grant share options in the first place? Notwithstanding they might be EMI, why do they do it in the first place? Well, it's all about recruiting, retaining, and incentivizing key employees. We're seeing more and more in the market, in the war for talent, that a lot of companies, they're having to promise some sort of equity in their business in order to recruit some of the top employees and directors. And also it works as a good retention tool. It's very sticky if you've got employees with options and they want to realize the value of those options. It's especially useful for earlier stage companies, which often don't have the cash to compete with some of the bigger players. So typically, if you're a smaller company and you want to hire some top programming talent or top engineering talent or top finance talent from a larger company, then chances are you probably can't compete with them in terms of salary offering, but you can offer tax efficient EMI share options as a way of making up for that. And also investors like to see an incentivized management team. So you'll find that once businesses get to an institutional investor level, so maybe they're doing their Series A, for example, the investor will like to see either an EMI scheme in place already, or there'll be some sort of agreement that an option pool is going to be put in place and an EMI scheme implemented shortly after the investment happens. So that's broadly speaking why companies do share options in the first place. And now we'll move on to specifically, well, why is EMI so appealing? So EMI is a relatively flexible scheme. So say it can apply to the majority of small to medium-sized growing companies. There are a few restrictions on the type of company that can do it, but most should qualify. It's very well trodden. This has been in place for over 20 years. The legislation surrounding EMI. There's no indication that the government are going to draw back any of the tax advantages that have been given. In fact, historically, they tend to have made it more and more generous over the years. So it's well trodden. The implementation is, I'd say, relatively simple. There is a process involved in it, which I'll come on to later, but it doesn't, for example, require a special purpose trust to hold the shares or some sort of linked savings account, as you sometimes see with some of the schemes that listed companies do. They often have to involve an employee trust and a savings arrangement, and it gets very complicated very quickly. No requirement for that with EMI. It's just a share option contract between the company and the employee, and a couple of other administrative and tax arrangements that I'll go on to later. There's no upfront cost for the participant, which is obviously great news from their perspective. The last thing you want to do is say, here are some shares or some options in my company, and by the way, you've got to pay for them upfront, or you get an upfront dry tax charge. That's the last thing you want to see. So no upfront cost for the participant, which is great, and highly tax efficient for the employee and the employer. We'll go on to some of those efficiencies a little bit later. We'll explain them in a bit more detail. So there are some restrictions around company activities and ownership structure. So for example, you can't, if your business is owning and operating hotels, then you can't do EMI. If your business is farming, you can't do EMI. There are various trades that don't allow this, but the vast majority of trades will be okay. And also there are certain ownership structures that won't apply. For example, you can't do EMI in a subsidiary company, but you most likely can do it in the parent company, which is fairly common. You have a trading company and then maybe a parent company. You would have to do EMI in the parent, but it should still be doable. So that's a broad overview of why EMI is appealing. And I promised you tax advantages, and here we are. Key tax advantages of EMI schemes. So the first point is you don't pay any tax on the grant of the option. So it'd be pretty disincentivizing if employees did have to pay tax on the grant of the option. And provided the exercise price for that option, or the strike price it's often referred to, as long as that's set at the market value of the shares at the date of grant, then the exercise of that option will also be tax-free. So if you have a share valuation of £10 and you set the exercise price at £10, then notwithstanding that value could go up over time, there shouldn't be any income tax due when the option is exercised. And the tax the employee will pay is when they dispose of those shares eventually. They will pay capital gains tax, but that's at a much reduced rate compared to income tax. It's at a top rate currently of 20%, and you can even get that down to as low as 10% if the option or the shares have been held for at least 2 years. So you compare that with some of the income tax and national insurance rates, it's a pretty significant saving. So from the employer perspective, they shouldn't be paying any employer's national insurance. So that's a 15.05% saving potentially there already for the employer. And the company also gets corporation tax relief on the exercise of the options, which is great news. So if you have the options standing at a huge gain because the share price has gone up a lot, then notwithstanding that the employee doesn't pay any income tax on that gain in value, the company will get to benefit from a corporation tax deduction, which is sounds too good to be true. I often describe it to clients as free money, but yeah, it's a very valuable deduction from the employer's perspective, as say a deduction for an EMI option can often wipe out any corporation tax due for a long time. So the overall headline rate is, with EMI, you should be getting into a 10 or 20% capital gains tax rate versus potentially 63.3% top income tax and national insurance rates for the equivalent cash bonus. So that would be if you're paying, let's say worst case scenario, 45% income tax plus 3.25% employee national insurance plus your employer's nick of another 15.05%, you get to this horrible figure of 63.3%. So there's a clear tax reason why you would want to do EMI and get within the 10 to 20% rate. So what are some of the key design considerations for EMI? Well, firstly, there's who do you grant them to? Traditionally, you see share options aimed at your top level employees and directors, but we're seeing more and more common that the companies actually say, no, we want to grant these to everybody, that every employee is a key part of our business, therefore everybody gets share options. And we just calibrate how many share options different people get. So clearly your more senior people tend to get more options, but at the end of the day, everybody gets something. You need to think about what percentage to allocate to the option pool. Investors will often have a preference, especially institutional ones. Typical might be 10% option pool in a reasonably early stage company, and that might grow to 20% towards the more later stages. We need to decide if the scheme is exit only, i.e. you can only exercise your option and get your shares if there's, say, an exit event, so sale to another company or a PE or perhaps an IPO. That would be the more traditional route, is they're exit only. But some companies are saying, no, we'll let you exercise a bit early if you want to. So as long as you hold your option for, let's say, 3 or 4 years, we'll let you exercise and become a shareholder. So you need to have a think about which of these design considerations you're going to go down, whether you are going to do exit only or 3 to 4 year vesting, who you're going to grant the shares to, and how you're going to allocate that pool among employees. So when is a good time to implement EMI? And this question has multiple facets, trying to balance the tax and the commercials. Generally, sooner is better. And the reason is that can lock in a low share valuation. So the real good news stories that you see with EMI is where employees come in at a low price because they've got their options at a point in time when the company's still early stages, and they stay with the company all the way through to that exit event, and they make a considerable gain at the end of it. So the sooner you can get the EMI in place, the better it is from a valuation perspective, because we generally try and agree as low a value as we can for EMI. Typically, it's best to implement once the bulk of the management team is either in place, recruited, or at least identified. So this is aimed at, tends to be key employees, so you need to at least know who you're granting your EMI scheme before you set one up. But once you've got those key people through the door, then that's the point in which you should start looking at how we incentivize them and should we do an EMI scheme. It's often implemented between EIS rounds. So it might be the case that before one EIS round, the company just simply doesn't have the cash to pay the professional fees, for example, to set up an EMI scheme, or perhaps it's the key people it wants to grant the options to. Perhaps they're not formally engaged as employees yet. We often see that the company has to get the funding to then hire the right people to then grant the options. So it's often done between EIS rounds. As say, institutional investors like to see incentivized employees, so they will often insist on doing an EMI scheme once they get involved. So that's when we typically see these implemented. And we now gone into the how do we implement an EMI scheme, so the nuts and bolts of it. So I've broken this down into 4 stages. So firstly, there's reviewing the company's qualifying status. As I say, most early to mid-stage growth companies should qualify for EMI, but it's always worth checking that you do meet all the requirements. The rules are very, very similar to the EIS qualifying rules. So as a general rule, if a company qualifies for EIS, and bear in mind that can be cleared with HMRC beforehand to get certainty. If the company qualifies for EIS, then chances are it will qualify for EMI. But it is worth doing just some sort of review just to double check. So review company qualifying status, agree a share valuation with HMRC. Now, this is not a strict legal requirement, but we always recommend it. As I say, you get tax-free growth in share value on the proviso that we set the exercise price at the current value of the shares, or the value at grant. So how do we know what the share value is at grant? The answer is, in private companies, there's not an obvious answer. But what we can do is write some sort of valuation report, send that to HMRC, and hopefully a few weeks later, we get HMRC's blessing to say, yes, that's the share value, go ahead. So there's a process for agreeing that with HMRC. We then do the legal drafting. So EMI can be, there's different ways of drafting it, but typically it's a set of plan rules, like a 30-page chunky set of plan rules that nobody ever reads. And then you have an individual option agreement for each employee that might be 4 or 5 pages that contains the detail of their option. And there's a few other admin points around drafting, like board resolutions, working time declarations, etc. But you can summarize it within legal drafting. And then last but not least, you need to notify HMRC that we have granted some EMI options. And there's a strict time limit of 92 days to do that. Quite an easy process, but one that you sometimes see missed and is very important. So once you've gone through those stages, you've checked that you qualify, agreed the valuation with HMRC, done the legals and notified HMRC, then you have a qualifying option. And I hope that's an adequate summary of EMI and why and how you would do it. And at this stage, I'll hand back over to Sarah and would be delighted to take any of your questions.
Excellent. Thank you, David. That was a really helpful scene setter. I've got a few questions, but I was just going to dive straight in with one that's already come through from Sheila in our audience. And she has asked how much it costs to set up an EMI scheme. First part of the question, and then the second part is, what do you think of companies such as Vested, which claim to do this for you at low cost? So an automated self-service platform. I don't know if you've seen Vested, but it's a DIY platform for.
Yes, come across them. So I think with these types of platforms, they've been around for maybe 2 or 3 years or so. I think you have to go in with your eyes open with these things. Can they do an EMI scheme? Yes. Will you get the associated level of service that you get from using something more traditional like an accounting or a law firm? Most likely not. You'll get a set of scheme rules. They can potentially agree a valuation with HMRC. What they won't do is give any tax advice. What we typically find with when we're implementing EMI schemes is you get a lot of queries from employees saying, well, what happens if X happens? What if scenarios? And I think that's where having the benefit of somebody that's got a bit more experience in these things can help compared to an off-the-shelf solution. I also find with that type of platform, you'll be very much pigeonholed into a certain type of scheme and certain type of way of drafting. Now, if what you're doing is very, very plain vanilla, then that might be acceptable. Whereas if you want to do anything that's just slightly different to what their standard solution is, then you may find yourself getting in a bit of a pickle with that. So I think the answer is you can use them, but use them with a bit of caution and make sure that make sure you've evaluated why you're using them instead of the more traditional option.
And what are your charges typically for a relatively straightforward EMI scheme?
Sheila's actually, the figure that she's quoted there, the 7K is actually pretty much bang on with what I expect to charge for a reasonably plain vanilla scheme. So that would include checking the company qualifies for EMI in the first place, agreeing the valuation with HMRC, doing all the legal documents, the plan rules, option agreements, etc., and making sure the notifications are dealt with HMRC.
I just to kind of go back to my questions, I wanted to follow up with you a bit on timing. So we worked with a startup recently who had pre-seed funding, or they got pre-seed funding from Scottish Enterprise. So this was really their very first external round of investment, relatively modest amount. And Scottish Enterprise actually required them to set up an option scheme before that first investment round, so that they wouldn't be diluted. And actually, we see companies setting option schemes fairly early in the journey. So often past the first raise because they need the cash. Is that typically what you're seeing as well, or does it tend to be more people at Series A coming to you?
It's a complete mixed bag, Sarah. Pre-Series A, yes, very common, and it does lock in those tax advantages such as the valuation. What I do see surprisingly often is companies that have talked about doing an EMI scheme since way pre-Series A, but never actually got round to doing it until they've actually got an institutional investor in there and saying, guys, you have to do this. So what you often see is there's been promises of EMI options for years, but then it sometimes takes all that time before they actually get it into place. And well, how does that work if the valuation has moved up during that promised period? So it's a complete mixed bag.
Okay, and does it, about establishing the price with HMRC, is it helpful then to link it to an investment round so you have that evidence?
Yes and no. It's helpful in that it can often demystify the process. If you do have an investment round, that will often be the starting point for valuing the shares. So it can make the valuation a little bit simpler, in that you're not having to, for example, calculate valuation on an earnings multiple or a dividend yield or something of that nature, which say can be even more difficult if a company's still loss making or not paying dividends, etc. So having an investment round does make the valuation a little bit simpler. It can mean that it's perhaps higher than it otherwise would be. We often see what companies want to do is they want to get EMI options in place before the next investment round comes in, because they know that in a few months' time they're going to get an investment offer. It's going to value the business at 3 times what it was previously valued at the earlier round. Therefore, you want to potentially get the valuation agreed and the options granted before we get that spike in valuation. So I would be a little bit wary about habitually waiting for an investment round, because it can end up ascribing a higher value to the business than you otherwise would have had to have got earlier on.
Okay, that's interesting. And then you mentioned employees getting options typically, but we've also seen where founders are granted options, and sometimes advisors, maybe investors who give some advice, are given some options in the company as well. Is that fairly typical? And
it's becoming more and more common. There are two questions there. I think there's separate answers. So there's the founders piece, which I always think the EMI options to founders, that shouldn't happen, but in practice it often does. The reason it shouldn't happen is, well, the founders start with the equity, therefore it's usually them giving it away rather than taking it back. But what we do see in practice is a lot of founders are perhaps a little bit, I should describe it, a little bit trigger happy with some of their equity in early stages. They give away a bit too much to a few too many people, and then they find later on, hang on a minute, I started with 50% of this business, I'm now down to 20%, and perhaps they need a top up. And yes, you can use EMI to top up founders that have ended up diluting themselves more than they'd wanted to. So that is reasonably common for the more mid to late stage businesses. Your question on contractors and consultants, that is becoming more common to grant options to consultants and advisors. I would stress that that's not going to be an EMI option. You have to be a full-time employee to get EMI. But you do nevertheless see companies sometimes grant options to those types of individuals. What I would say is you have to be a little bit careful about how you do those options. So there are some legal problems with granting options to contractors in the same plan as granting to employees. So what you often do is have two separate plans, or you have the contractor plan as being a sub plan to the employee plan. So perfectly doable, but you do need to make sure that you keep some degree of separation between those. And also from a tax perspective, I've described all the tax advantages for EMI options for employees. For options for consultants, they will follow their own tax rules as self-employed individuals. And I would tend to steer away around giving them tax advice on their options, because it will depend on their individual circumstances, whether they're a sole trader or a corporate, and often these advisors are based overseas as well. So I would try and steer away from guaranteeing what their tax position will be.
Okay, that's really interesting. So they're on a different scheme from employees.
Yes.
Question from Joe. We've got quite a few coming in from the audience. So question from Joe. She's saying, thank you for the presentation. We have an existing EMI scheme and need to add new people. Mm-hmm. What is the process? Is it better to start a new one or add to an existing one?
It's a good question. Good question. Tends to be stick to the existing one. But it does very much depend on how it's been drafted. So the way I described an EMI scheme as drafted, and this is how I do it myself, but it does vary a little bit depending on which advisor you've used, etc. What you'll typically see is you have a set of scheme rules. So that's a big 20, 30 page document defining all the terms, etc. And then you might have an option certificate for each participant. That might be 3 or 4 pages. So if you've done it that way, what I would tend to recommend is you keep the same set of scheme rules, and then we just issue some more option certificates based on the same plan rules. And that tends to be the most common route. There are some limitations to that. So if your set of scheme rules is 5, 6, 7 years old, then you may want to have a look at it and see, well, is this still valid? Because say legal rules do change and tax rules do change over time. So there are certain terms that we see in old EMI schemes that actually we should be getting rid of and replacing. I think one of the key dates is 2016. There were some changes in EMI legislation around, for example, stating restrictions over shares. You didn't have to state them pre 2016, whereas you do have to state them afterwards. So we sometimes see problems with people rolling forward old precedents. But if your EMI scheme precedent is reasonably new, so done within the last 5 years or so, my general inclination would be to reuse the scheme that you already have, rather than set up a new scheme every time you do another option round.
Okay, and a sort of follow-up question from Kanika on the same subject. So if you're extending an existing EMI scheme from say 10 to 20%, is it okay for the strike price of a later scheme to be more than the existing scheme? Is
Yes, Kanika, yeah. So generally, if you've got options over 10% now and you're widening it to grant to say some new employees or giving top-ups to existing ones, it's not unusual that the strike price or the exercise price for those later options might be higher than the earlier ones. And the rationale behind that is, well, there's a tax rationale in that the valuation you agree with HMRC might be higher now because the business has grown, it's got more investment, etc. And commercially, the founders or the investors might say, well, hang on, we granted options at a 5 million value when we're a 5 million business. We're now a 20 million business, therefore we want to grant you options at a higher strike price because commercially they don't want to give away value that's already accrued. So yeah, very, very common for the strike price to go up over time, or potentially it can go up and down depending on how the business goes.
Okay, and is that a relatively straightforward process?
I think it goes back to Sheila's question of if you can just use the set of scheme rules that you already have, if they're reasonably up to date, don't require any fundamental changes, then yes, you can you potentially need to go through some exercises to get authority to grant those options. So you want to make sure that the directors have the requisite authority to grant those additional options. They're not going to get in trouble with investors. But yeah, providing the permissions all there from investors and the scheme allows that 20%, then yes, you can use the same set of scheme rules, just grant some new options over that scheme. I would recommend at minimum you get a new valuation agreed, because chances are your old valuation is not going to be relevant anymore. Those valuations tend to last for 120 days. So depending on how long ago you did your first round, you're probably going to need a new valuation. But yeah, it makes sense to recycle the rules as you can.
Okay, and then going back to the tax advantages. So you went through the tax advantages to the company. Sheila's now asking, what are the tax advantages for employees?
Okay, so for employees, I mean, it depends what your base case is, but I would say if you compare your base case of EMI versus a cash bonus or a non-EMI or unapproved option, as they're sometimes called, then that would deliver gains to employees at income tax rates, so 45% plus national insurance, versus EMI, where the advantage for the employee is they get their gains into the capital gains tax regime rather than income tax. So the rate that they pay on their gains is going to be 10% or 20%, worst case scenario being the top rate of CGT. So I think I gave some figures earlier that it's 10 to 20% capital gains tax for the employee versus 63% income tax plus national insurance.
Yeah. Okay. And obviously you've got your CGT free allowance each year as well. It's not a huge amount, but some of it will be free of any tax, won't it? So
yes, yeah, of course.
Okay. So Ileana has asked, what is the best way to deal with co-founders and early C-level hires? Should there be a share split before the option scheme is set up or form part of the pool? What if that increases the pool above 10%? So I think that question's to do with founder shares, which are quite separate from the option pool, aren't they? But
yeah, and there's not necessarily a right or wrong way of dealing with it. probably the most common is just to keep it simple, just to have one class of share. So just to say there's an option pool of, let's say, 10% to be given to your key employees, and we just manage the numbers so that we don't go above that, so we don't start overly diluting the founders. That said, it's also possible to use different classes of shares to demarcate the founders and the employees. So what I've seen in a couple of examples of clients is they said, we want a 15% option pool, and we never want it to go above 15%. And so the way we did that in practice is we did a new class of share, and the Articles Association said, this class of share ranks the same as the founders' shares. However, as a class, these shares cannot exceed 15% of the, or they don't get more than 15% of the economic rights of the company. So they then granted options, got up to that 15% mark, and then they carried on granting options, but all that did was diluted the existing option pool. It was always structured such that the founders would always keep the 85%, and those additional options would just, you can think of it as being a set size of pie, and it's just dividing up that pie differently. So I don't know if that's completely answered your question, Ileana, in terms of separate share classes or keeping them the same.
Yeah, I mean, if you're really, really early days of the company, normally the founders will split the shareholding between them in some form that they agree, don't they? And then the option pool is carved out of that total shareholding, so it dilutes the original founders, but the founders will get shares as opposed to employee options, if that makes sense.
Yeah.
If we're not answering your question, Ilana, just please try asking again. Right, okay. So Jessica is asking a clarification question, is that, does a share options agreement offer an employee the right to buy shares when they have vested at the price originally granted?
Okay. Broadly speaking, Jessica, yes. So it's an option to buy shares. It's not a put option where you can sell shares. Completely the opposite. It's buying shares. When they've vested, the term vest can mean a lot of different things to a lot of different people. So I'd be a little bit careful on the wording. You can have vested shares that still aren't exercisable, whereas in other schemes, vesting means fully exercisable. But let's say we're in a scheme where vest means you can exercise, then that will typically be at a fixed price that's been agreed at the offset. So we agree the strike price is £5 a share because that's what we agreed with HMRC, and that will be fixed. So it doesn't matter what happens to the share price after that, you pay the £5 that was agreed. It is technically possible to have a variable share price. So I've seen some companies do that where the share price can vary depending on for example, if there's an exit, it can vary depending on how big the exit is. But that's relatively rare. I'd say 95% of the time, it's just a fixed price that's agreed at the date of grant. What happens if they don't purchase the shares?
They just remain in the pool, presumably, don't they?
Yeah. So you might have, for example, a vesting condition that would say you can exercise after 3 years, and once you get to that 3 years, typically employees aren't forced to exercise because they might not want to, because they might not have the cash to do that, and there's potentially not any way of selling those shares. So it's fairly common the employee might say, okay, I have the right to exercise, but I'm going to delay exercising because I want to wait until there's some sort of capital event, an IPO or a sale. Whereas when you get to those types of capital event, let's say we are being bought out by a competitor or selling to a VC or something of that nature, then typically the exercise might be, maybe enforced is the wrong word, but you can have a scenario where you have to exercise during this period, and if you don't, your option will lapse. Typically that only comes into place in the type of corporate transactions, because you'll see, for example, a buyer won't want to buy out a company and then have latent options that for some reason somebody didn't want to exercise. It's far more common just for everybody to exercise and then sell their shares as part of that transaction. But generally speaking, if there is no transaction on the table, it's just options become exercisable after a passing of time, then typically it's just a right to exercise, but not an obligation.
Okay, so we've had a thank you from Ilana, so I think she's happy with our answers. Sheila has asked if we can provide some examples of rules for EMI schemes. For example, is it better to keep non-voting?
So the plan rules tend to be a big document, so 20 to 30 pages. So I wouldn't try to summarize everything in a call here. There are certain, so non-voting, for example, I typically wouldn't see anything in an EMI option documentation that would say the shares are non-voting. Typically, the voting issue can be dealt with in two ways. The first way it's often dealt with is we see probably 70% of the schemes that we implement are exit only. So you only get to exercise if there is a sale of the business. And so in that sense, if you're only exercising immediately before sale and then selling your shares immediately, the voting rights is a bit of a moot point because you're not going to hold the shares for any length of time that would allow you to vote. And whilst you hold an option over the shares, that doesn't give you any right to vote because you don't technically hold the shares yet. Now, in schemes where people can exercise a bit earlier, let's say you get to your 3-year vesting and you can exercise, then I think that is a very valid point you've raised, in that, well, what do we do about voting? Typically what founders want to do is they want to restrict people from voting. They don't want dozens of small shareholders that have got shares from EMI options voting on company matters. And typically the most common way of dealing with that is just a separate class of share. So you have ordinary shares held by the founders. You might have a separate class of share held by the investors for various reasons. I'm sure most of you are familiar with that. You might also have a separate class of EMI share. Sometimes that class has some very different rights, but in other cases, it might have exactly the same rights as the founder shares, just they're not allowed to vote. So you would typically see that done within the company's articles of association via a separate share class, rather than within the EMI scheme rules themselves.
And I just wanted to ask a question about how do you deal with the options of people who leave the company?
So that's it's an interesting question, Sarah, and one where different companies take divergent views. You can be very generous, or you can be not so generous. I remember being in a meeting with a management consultant once, and he described it as the Florence Nightingale to Genghis Khan scale. And he inadvertently described my boss at the time as being a Genghis Khan. So some companies take a very strict view that if you leave, you lose your option. No ifs, no buts. We gave you this as a retention tool to keep you here until, let's say, an exit. If you leave before then, tough luck. Others take the more lenient view that they say, right, we're going to have, let's say, a 4-year vesting period on these options. So or maybe 4-year vesting, 1-year cliff. So after you've been here for a year, you start accruing those shares and they become safe. And the rationale is, well, you've done your work to earn those shares, therefore you get to keep them. And so we do see those two different schools of thought. And others have somewhere in between. They say, well, you do lose your shares, but maybe you get to keep them if you're within certain good leaver scenarios. So if you leave the company because of ill health, disability, retirement, maybe even redundancy, then you'll get to keep your option. Whereas others take a more hardline view that no, if you leave, you lose it. There's no right or wrong answer, but I would say the more generous end of that used to be very rare, but it is becoming increasingly popular for people to keep their options if they've earned them over a few years. I think companies need to go into those types of arrangements with their eyes open and understand that it does mean you could have a lot of ex-employees that haven't worked for your business for 5 years. You could be having to chase them down on an exit event to say, here you are, guys, here are your proceeds. Maybe even some of the tax advantages might be lost in that scenario.
So that's we know a business very well that had a good exit after 10 or 12 years, and they had been very generous and they'd granted every employee options. So on exit, they had this scenario of a couple of hundred former employees that they had to sort of try and track down around the world, because best will in the world, not everyone stays in touch. People do move and stuff like that. So are there ways to be generous but kind of protect yourself from that? That's the last thing, dealing with all the exit kind of bureaucracy that you need to be trying to find people. How do you protect yourself from that scenario without being too stingy?
I mean, in some cases the stingy route just works better. If you are going to be generous, then there are certain arrangements you can enter into, like powers of attorney, for example, just to smooth over some of the administration. I would still say if you're going to go down the generous route, you should have a serious think about, well, is this really what we want? Do we really want ex-employees having this entitlement? Do we want to have to figure out the tax implications of that? Because, say, the advantages that you get for employees for EMI, for former employees, the position gets a bit more complicated, and you might have part of their gain being capital and part of it you're having to put through pay as you earn and national insurance. So I think very carefully about if you are making it generous. But yeah, there are practical things you can do around, for example, powers of attorney that can smooth over a bit of the admin.
Okay, thank you very much. I think we've come to the end of everyone's questions, unless anyone's got any last minute ones. So I just wanted to ask you, David, if it's okay, it's not a huge number of people on this call, is it okay to share your email address with them?
Yes, of course.
In case they had any follow-up questions.
Of course.
Before everyone goes, we just wanted to share a few other links. So Michelle was going to put David's email into chat, and we've got a few other links to share. But David, thank you very much for your time and insights. It's been incredibly helpful. We had a really good mixture of investors and founders on the call, so quite a variety of questions. And we'll be in touch soon, and yeah, people can follow up directly with you if they have any other follow-up questions.
Thank you, Sarah. Thank you, Simon, and thank you everybody for your enthusiastic questions and
you're welcome.
Taking the time.
And we just wanted to make a general reminder that if you're a founder raising investment for growth for your technology business, apply to pitch to Angel Academy. Our criteria are on our website. If you're interested in joining us as an angel investor, please contact Michelle for details. And please subscribe to our newsletter, LinkedIn, and all these sessions get recorded. This one will be put on our YouTube channel, as well as previous ones we've done on things like EIS, due diligence, and all the different aspects of angel investing. Right, well, look, that's all from me. So thank you everyone for your questions and for paying attention, and I hope to see you all soon. Enjoy the rest of your day.
Great. Thanks all.
Bye, David. Thanks.
Cheers. Bye.